If you're a dividend investor and you're looking for some great ETFs that focus specifically on paying those dividends, I got 5 ETFs to share with you in today's video. We're also going to look at the future growth and how this all works a little bit later in the video, but let's get started with ETF number 1 and a 5. Now, these are not monthly paying ETFs. Every ETF on today's list pays quarterly. Number 1 on the list is DGROW. This is the iShares Core Dividend ETF. Right now going for $50.24 per share with an expense ratio of only 0.08%, which basically means for every $1,000 you have invested, that expense is only 80 cents. And the dividend rate is going at 2.28%. Now, what iShares does is they focus on tracking of the Morningstar US Dividend Growth Index. And they actually have 3 different requirements in order for the companies to be listed within that particular index. Number 1, they have to pay qualified dividends in order to be in this index. Number 2, they're screened for a minimum of 5 years of uninterrupted dividend growth to their shareholders. And number 3, they have to have significant margin to continue to grow those dividends over the long period of time. And that's where we can see this for ourselves. In fact, right here on Seeking Alpha, if I click on the dividends tab and we scroll right down here, you can see that dividend rate of 2.28%. But most importantly, look at the 5-year growth rate at 10.61% and a consistent dividend growth year after year of 8 years going. So this does pay quarterly, the last payment at 33 cents per share paid out on 12/19. There are a total of 452 stocks that make up DGROW. You'll notice a lot of the dividend ETFs will hold things like ExxonMobil, JP Morgan, Johnson & Johnson, and things like that, but there are some stocks, depending on the strategy of the ETF, that will change around either the percentage of what they hold or the company altogether. But here are the top 10 holdings of DGROW. So that's DGROW. Let's move on to ETF number 2. ETF number 2 is Noble. This is the ProShares S&P 500 Dividend Aristocrat ETF. Now, in order to be classified as a Dividend Aristocrat, if you're a company or a stock, is that you have to meet a few qualifications. Number 1, you have to be listed in the S&P 500 index. And you have to consistently pay a dividend and raise that dividend year after year for at least 25 years consecutively. So Noble does have a higher expense ratio at 0.35%. which means for every $1,000, it'd be $3.50. But some of the holdings of Noble, they have a total of 65 different holdings. You're gonna have companies such as W.W. Grainger, Chevron, you got Archer Daniels, you got ExxonMobil, Caterpillar, West Pharmaceutical, and so many more. Now this fund has been a little bit weird as far as its dividend growth. It's had a little bit of trouble over the last couple of years with COVID and whatnot. Dividend growth of 0 years. So that's a little bit of a thing to keep an eye on. Dividend growth rate is at 9.37%, which isn't bad, and the yield is 1.88%. So one of the lower ETFs on today's list, which we'll see how this one performed against its peers a little bit later in the video, but let's move on to number 3 on the list, which is HDV, iShares Core High Dividend ETF, focused specifically on companies that pay that high dividend, giving it a whopping exciting 3.5% dividend yield with an expense ratio of 0.08%. Now, you may look at the price of HDV and be like, wow, that's a lot of money, $103 every single share. Now, keep in mind that you don't have to buy a full share every time. You can actually get a fractional share. In fact, companies like Webull, Robinhood, things like that, they offer you the ability to invest fractionally. So for example, you could invest in maybe half a share or 0.25, or just put like $5 into the fund and you'll get a fraction of a full share. Now, how you would calculate that, you would take that and you would multiply it by the percentage of the dividend or how much dividend they're paying each and every quarter. Here's how you could do that. So let's say, for example, on HDV, we decide we're gonna buy a fraction. We're gonna buy actually a half share. So let's hop over here to the dividends first on Seeking Alpha. We come down here and you can see the last time that they paid a dividend quarterly was on 12/19/2022 in the amount of $1.14 per share. So what you could do is get out your calculator and let's say you have that half share. You do 0.5 times $1.14. So you would get paid 57 cents on this particular thing because you only own half of a share. Doesn't sound like a lot, but if you invest it the right way and you continue to grow your portfolio with disciplined practice, that dividend snowball can grow quite large. So why don't we hop over to number 4 on the list? And number 4 ETF that pays a great dividend, DVY, iShares Select Dividend ETF. Right now going for $121.83, another big one, another more expensive one from a price perspective. However, if you look at their dividend yield, another good one at 3.33%. So obviously you get what you pay for there. The expense ratio a little bit higher than the other ones at 0.38%. This one has a total of 105 different stocks that make up this ETF. So let's go to the last one on the list before we get into the exciting part of comparing these things and seeing what this looks like for the future of your portfolio growth. The last one on today's list is VYM. Now there's another video that we did on SCHD, but this one's almost like a competitor, a sister, cousin or something to SCHD, but it's owned by the Vanguard Group. And it's focused specifically on high dividends. So right now their dividend yield at 2.94% with the best expense ratio here in this list at 0.06%. Some of their holdings, of course, we got the ExxonMobil as I mentioned earlier, but they do include J&J, JP Morgan, Procter & Gamble, Pfizer, so on and so forth, a total of 443 holdings. If we hop over to the dividends tab, let's take a peek at that as well. You can see that their dividend yield 2.94, but their growth rate at 6.25%. At 12 years. So they've continued to grow the dividend within this particular ETF over the last 12 years, thanks to, of course, the type of stocks that are in this particular fund. Their last announced dividend was paid quarterly at 97 cents per share, paid out on 12/22. If you're looking for like monthly paying ETFs, let me know in the comments below and I'll come back with another video. But how do these, on today's video, stack up against each other? And most importantly, how do they stack up against the S&P 500 overall stock market index? Well, let's take a look at that. Hopping over again to Seeking Alpha, I'm going to go over to their comparisons tab. And right here we have them, all 5 of the ETFs that we just reviewed in today's video in the last year alone. Now check this out. You can see how they're kind of going up and down. But remember, in 2022, we had a very bad year in the stock market. The stock market went down, I think it was like, what, 18% or something like that? Not a good year. So it's really interesting to me though, when we look at this particular chart, take a look at HDV. The only one out of this group that's actually in the positive at the end of the year in 2022. That's super interesting to me. I mean, look at it indicated by the green line here. It's kind of up and above. Do you see that? That's kind of cool, isn't it? And then, of course, you have some ones here at the bottom. You know, you got Noble down here and you got Degro at the bottom. So obviously that can happen. But remember, past performance doesn't always mean future growth potential. There's a lot of risk when it comes down to investing. And this is not financial advice to buy any of these ETFs. This is just some examples. And it's up to you to do your own financial research. Let's stack this against the S&P 500 though. I can hit add comparison. I'm going to choose SPY. That is the Spider S&P 500. That one tracks the S&P 500 index. Best way to kind of test this against all the ones that we put on today's list. Let's check that one out. And look at this. SPY, indicated by that dark blue, almost like a purple color, way down here. Like I said, 2022 was a tough year. Look at all these dividend ETFs in this video outperforming the S&P 500 this past year. But it's not all sunshine and rainbows. I'm not here to lead you down this path of, oh, look at this. These things that we talked about today in this video are better than the S&P 500. No. Let's zoom out for a second. If we go to the 5-year chart, for example, right here, things paint a little bit of a different picture. Take a look. Now we have that dark blue, purple line for the SPY above all the different dividend ETFs. And the reason for that is typically when you see a bull run, when the stock market's going up, like it did in 2021, a lot of times dividend ETFs don't grow as feverishly as the overall S&P 500, and most certainly not as much as a growth ETF. But it still does grow. And that's a key point. A lot of times when we talk about dividend yield, especially this year, a lot of people focus on inflation. Like, you know, you got a 3.5% dividend yield, but hello, inflation's running hotter than that. What the heck? Well, remember, you're not only gonna get that dividend percentage yield, you're also gonna get growth, especially in ETFs that focus both on income and growth. And that's what's going on here. Now look at the 5-year chart. Even though SPY has outperformed all the other ones that we looked at today, take a look. We have Degro growing your price percentage at 41%. So if you would have invested 5 years ago into Degro, you're now up 41%. You look at Noble, you look at HDV. Now HDV actually doesn't look that good at only 4.06%, but take a look at DVY. Take a look at VYM. These, of course, stacked on top of the dividends that you're gonna get paid, kind of make it nice from your overall investment portfolio. But let's say you want to grow your income and you wanna make at least $100 a month. Well, that's where the dividend tracker comes in. In fact, if you have the dividend tracker right on the left-hand side, under calculators, click on the first option that says income goals. We're gonna plug this in and check it out, and it'll actually show us split up how much you would need to invest in each one of the funds that we looked at today to get whatever annual income goal you want. Now, $100 a month means $1,200 every year. And I'm going to plug in the tickers right now. So here we are at all of our ETFs that we looked at today. We have a total of $1,200 a year, which is $100 a month. Let's hit calculate. Now what you would need to do is invest $37,000 with the following breakdown. This, and this. Kind of split up evenly, but it also tells you how many shares in each one of these funds that you would need as well. Now that might sound a little overwhelming. Oh my gosh, I got to invest $37,000 just to make $100 a month? Kind of dumb. Well, hold on. Let's take a look at the future growth now. Let's say you build up to that $37,000 and you're going to continue to invest $200 every month forever, for at least the next 25 years. That's where this next calculator comes in handy. So you're going to automatically make $100 a month once you get up to this $37,000. I'm going to copy that amount and come over to this calculator that says future value. Click on that and we'll hop over right here where the starting principal will be that amount exactly. The monthly contribution will be $200 as we just talked about. Annual dividend yield percentage, we'll leave that at 2.6% with the dividend growth rate at 2%, annual share price growth of 10%, and number of years, let's do 25 years. So let's see how this looks after 25 years as you continue to invest $200 every month. Right at the bottom, in the year 2047, look what happens. You now have a portfolio value of $1 million. That's super amazing. And on top of that, you're getting paid $42,275 every year in dividends. And all it took was building up to that $37,000 and then continuing with a plan. And that's the key point, a plan to do $200 a month. Look, I know how hard it is because I did it too. It was like, how do I get, to where I want to be with my finances? And I found the best way to do it. Just start a plan and stay consistent with that plan. But remember, when we talked about this whole issue with, we got inflation and all these things kind of shaking us to the core, it's okay if you stick to the plan because at the end of the day, you continue growth. Then at that point, let's say it's 2047, you now have a decision to make. Do you want to just stick with, your $42,000 a year? You can eat into the growth if you want. Or you can let that $1 million continue to grow on. Now remember, these ETFs are focused both on growth as well as dividend income. You don't want to always just chase after the dividend yield. That's also called a dividend trap. We talk a lot about QYLD on the channel, and QYLD, that's a whole different type of fund. Whereas these ETFs here are focused on the growth and income, that one's mainly focused on income via distributions based on a covered call writing strategy. Now, the key thing about a covered call writing strategy is that it is really focused on only the distributions, not the growth. We can see that it looks amazing. Look at that, 13.2% dividend yield. And it almost makes you want to think, well, forget these 3% and these 2% over here. Let's just dump all of our money into that. We'll get a 13% dividend yield. That's amazing. But hold on a minute. The issue is it's not always focused on growth. Take a look at the chart and it tells you the story. Look at the last year, it's down 22%. Look at the last 5 years, down 33%. Now, while this fund can be exciting for the yield, you got to be careful sometimes with these particular growth patterns and really look at what the ETF is offering. Is it just income? Is it growth in income? Is it alternative investments? Always take a look at that kind of stuff. Get yourself a dividend tracker link down below to check out everything we just reviewed. Check out this video next and we'll see you on the next video.